Welcome back to the deep dive. Okay, we've waded through a mountain of market info from the last day or so, SEC filings, earnings, analyst takes, the whole lot.
Yeah, a real mix. News across fintech, media, retail, October 23rd and 24th, 2025.
And we've boiled it all down, trying to find, the signal and the noise for you.
Yeah.
What really shifted?
Well, the big themes today, it's kind of a clash. We've got some really impressive earnings wins, especially in digital finance.
Right.
But then you see some shaky guidance causing trouble, major M&A speculation heating up, and maybe most interestingly, a lot of insider selling popping up.
That's exactly it. So our mission today, pull out the three most critical shifts from all that data. We're thinking, number one, this momentum in fintech and lending.
Definitely.
Two, the ongoing drama around media deals, specifically Warner Bros., Discovery.
Thanks drama there.
And three, what we're calling the retail reality check, where a strong performance just wasn't enough.
It's fascinating, isn't it? The market seems to be saying, great job last quarter, but we're not so sure about next year. That disconnect is key.
Okay, let's unpack this.
Let's do it.
So, segment one, digital finance and lending momentum. Some really strong signals here. You have to start with Lending Club, right? LC.
Absolutely. LC's Q3 was, well, a blowout. They didn't just beat on earnings per share and revenue. They pretty much crushed the estimates.
And the EPS number was huge, wasn't it? Like nearly tripled.
Yeah, nearly tripled. That's not just a slight beat. That's a sign something fundamentally clicked.
So what drove that? Was it just more loans, or are they managing things better?
It really points towards much tighter cost control, I think, and probably smarter loan choices, maybe shifting to, less risky borrowers. It validates their whole shift away from just peer-to-peer lending towards being a proper digital bank.
Makes sense. And the analysts obviously liked it.
Oh, yeah. Upgrades and price target hikes came flying in JP Morgan, KBW, BTIG, all the big names.
Which explains the stock hitting a 52-week high.
Okay, so fundamental strength can still get rewarded big time.
Exactly. Now, while LC was nailing the fundamentals, Affirm, AFRM, was all about expanding reach. They announced a bigger partnership with WorldPay.
WorldPay, the payment processor. Why is that such a big deal for Affirm, for the whole buy now, pay later thing?
Well, WorldPay is massive on the back end. They power payments for countless software platforms, the SaaS companies that serve tons of online businesses.
Ah, okay.
So by embedding Affirm directly into WorldPay's system, Affirm gets instant access to potentially millions of merchants. It just makes it super easy for those businesses to flip a switch and offer Affirm's BNPL.
So it's an infrastructure play, really. Less friction.
Precisely. And the market noticed stock was up, about 3%?
Right. And even looking at crypto and trading platforms, Coinbase, Coin, they launched something new. Payments MCP.
Yeah, this one's interesting. It's maybe less about you and me trading crypto and more about the plumbing for the future. MCP stands for multi-party computation.
Essentially, it lets AI agents think. Bots, automated programs have their own wallets, operate on the blockchain, and send stablecoin payments directly.
So machines paying machines automatically.
Kind of, yeah. It's like laying the groundwork for automated, decentralized business processes, a strategic long-term infrastructure move.
Got it. And sticking with trading platforms, Robinhood, Hood, saw some big institutional interest.
It did. Cathie Wood's ARK Invest scooped up a significant chunk, about $21.3 million worth of Hood shares, across a couple of their ETFs, ARKK and ARKW.
So despite maybe some regulatory headwinds, big players like ARK still see value there.
Yeah, a clear vote of confidence in that retail trading model, or at least its potential.
Okay, let's shift gears from fintech momentum to, maybe stalled momentum in media. Segment 2, media mega deals and streaming dynamics. The spotlight seems fixed on Warner Bros., Discovery, WBD.
Yeah, the WBD situation has gone from whispers to almost public negotiation, it feels like. Ever since they confirmed that strategic alternatives review, like M&A, speculation has just been constant.
And the latest, there's this persistent rumor, right, that Paramount Skydance made an offer.
That's the chatter. An offer supposedly in the $23 to $24 per share range for WBD.
Okay.
And the follow-up rumor is that WBD's board said no, rejected it.
And then the counter rumor.
The counter rumor, or maybe lick, is that Paramount Skydance isn't willing to go much higher, maybe capped at $25 a share.
Wow. So they're potentially just $1 or $2 apart, and it's playing out in the press.
Exactly. It suggests the haggling isn't just about strategy, it's pure price disagreement. What are these massive content libraries actually worth in today's streaming mess?
And are investors placing bets?
Seems like it. We saw Phoenix Financial Ltd., for instance, significantly upped its stake in WBD back in Q2, like by over 150%.
So they're betting something happens a sale, a different deal, something that unlocks value.
That seems to be the play. Meanwhile, elsewhere in streaming, Netflix is still being dissected by analysts after its Q3 revenue and EPS miss.
Right.
And Roku confirmed its earnings are coming up soon, October 30th. So more data points on the way.
But the big picture is consolidation attempts hitting price walls.
Okay, that leads us nicely into our third shift, the retail reality check. This is where good news wasn't quite good enough. Let's talk Deckers. DECK.
Deckers. Yeah, the parent company of HOK and UGG. Look, their Q2 results were, on the surface, fantastic.
Beat expectations, right? Both earnings and revenue.
Comfortably. EPS was $1.82 versus the $1.58 expected. Revenue also topped estimates, around $1.43 billion.
And the brand's driving it. HOKA and UGG still strong.
Very strong. HOKA sales up 15%, UGG up 12%, and the international growth was huge, nearly 30% year over year.
Okay, so that offset weaker U.S. sales, which are only up slightly. Sounds like a great quarter. They did everything right.
They really did. For Q2, they nailed it. But, and this is the crucial but,
The guidance.
they projected full year 2026 revenue at $5.35 billion.
And the market wanted.
The market consensus, what analysts had penciled in, was closer to $5.5 billion.
So they guided maybe $150 million lower than hoped for, out of over $5 billion. That seems like a small gap. Relatively small, yeah. But the market reaction was brutal. Stock dropped, what, 7.4% after hours?
Ouch. So is that just resetting expectations, or is it real fear about the consumer down the road?
It feels more like punishment for not meeting those very high, maybe overly optimistic analyst expectations for continued acceleration. Plus, you have to factor in the wider economic picture, especially things like housing.
Yeah, we saw the existing home sales numbers missed expectations. Housing is definitely cooling.
And that flows directly into certain retail segments. We heard it straight from RH, Restoration Hardware.
Right.
Their CEO, Gary Friedman, explicitly said the slowdown in luxury housing is hitting demand for their high-end furniture.
And they're preparing for that.
They are. They filed an 8K, basically official notice, that they increased their revolving credit limit, giving themselves more financial wiggle room, shoring up the balance sheet.
Interesting. So RH is playing defense while Wayfair, W, is trying innovation. They launched that AI tool.
Yeah, Decker AI. It's a generative AI thing for virtual room design. So Wayfair's pushing tech, while RH is focused on financial flexibility amidst macro headwinds. Different strategies.
And speaking of headwinds and caution, this brings us back to insider activity, right? Especially in this home goods space.
Exactly. We saw a couple of notable sales reported. The CEO of Lovesac, ticker Love AE, Sean Nelson, sold shares. It was through a 10b5-1 plan, though.
Okay, maybe you can quickly explain that for listeners. Form 4, 10b5-1, what's the difference?
Sure. So a Form 4 just reports any insider stock transaction, buy or sell. A 10b5-1 plan is different. It's a pre-scheduled trading plan set up in advance.
Oh.
So when the Lovesac CEO sells under a 10b5-1, it could just be planned diversification or covering taxes. It's not necessarily reacting to immediate news.
Gotcha. But still a sale.
Still a sale. And then the CEO of Williams-Sonoma WSM, Laura Elber, also sold shares. That Form 4 said it was related to covering taxes from exercising stock options.
Which is common for executive compensation.
Very common. But again, bottom line, it's millions of dollars in stock being sold by top executives in the sector. It adds to that cautious undertone even if the reasons seem routine.
Right. It's a steady drip of selling, even when headline numbers look okay.
Precisely. Which brings us to our last collection of signals, health, beverages, other corporate stuff, still seeing that push and pull between outside optimism and maybe internal caution.
Let's hit some operational points first. Starbucks, SBUX, facing more labor issues.
Yeah, the Starbucks Workers United Union announced plans for strikes in about 10 U.S. cities. They're protesting new scheduling policies. That's a direct operational risk, potential disruption, higher costs.
Okay. And a key departure at Teladoc, TDOC.
That's right. The CFO, Malamurthy, resigned effective November 21st. That came out in an 8K filing.
CFO leaving is always noteworthy.
Always. Now, Teladoc did say their preliminary Q3 results look like they'll meet annual guidance, but losing your finance chief is still a flag you watch.
Definitely. And then there are bigger macro risks hitting some companies. Eli Lilly, LOY, seems caught in a couple of crosscurrents.
Yeah, two big ones. First, you know how popular those GLP-1 drugs are for weight loss? Well, analysis is linking their rising use partly to the jump in U.S. worker health insurance premiums, up like 6%.
So great for Lilly's sales, but employers footing the bill are starting to feel the pinch.
Exactly. Creates potential pushback down the line. The second risk is political or regulatory. There were reports of a potential investigation by the virtual Trump administration into global drug pricing.
Ah, the perennial drug pricing debate.
Right. Any big pharma company like Lilly is exposed to that kind of policy risk, potentially impacting profits overseas.
Okay. Shifting to beverages. More positive analyst sentiment there.
Yeah, Coca-Cola, KO, got an upgrade and target price bump from Morgan Stanley. They cited strong pricing power, good performance in emerging markets.
Makes sense. And PepsiCo.
Pepsi, PEP, just confirmed its regular quarterly dividend via an 8K, steady as she goes.
But let me guess. Insider selling.
You guessed it. Monster Beverage, MNST, reported a Form 4 showing a $1.2 million insider stock sale. It's just a persistent theme today.
Wow. Okay, and maybe the perfect example of this whole contradiction is Allstate LL.
Absolutely. Check this out. You have an executive, Thomas J. Wilson, selling a hefty $3.26 million worth of LO Commons stock. That's filed on a Form 4 clear signal.
Big sale.
But almost at the same time, analysts are looking at the stock chart, seeing what they call a bullish hammer pattern, and slapping a buy reading on it, Zacks rank #2.
So the executive is selling millions while the chart watchers are saying buy, buy, buy.
Exactly. It's the whole story in one stock. You've got fundamental strength like we saw at Lending Club.
The M&A price arguments like with WBD.
The punishment for slightly cautious guidance like Decker's got.
And this drumbeat of insider selling underneath it all. Perfectly shown by Allstate.
So the big takeaways seem clear. First, watch that gap between reported performance and future guidance. The market is really sensitive to guidance right now.
Right. Expectations versus reality.
And second, pay close attention to that internal activity. Executive changes, like the Teladoc CFO, and definitely these insider sales at Monster, Allstate, Lovesac, Williams-Sonoma, they might be signaling risks the market hasn't fully priced in yet.
Especially when analysts are still generally bullish, upgrading names like Coke and seeing buy signals for Allstate even as insiders sell.
That's the dichotomy.
So here's the final thought for you, our listener, to chew on. Why are corporate insiders, the people who know these businesses best, selling significant amounts of stock? We're talking millions, right when Q3 earnings largely look strong, and analysts are still pretty optimistic.
Are they just wisely taking some profits after a good run, or are they seeing something coming down the pike, maybe 6 months, a year out, that makes them genuinely cautious about the economy or their sector?
That gap between what insiders do and what the market says, that's where the real insight often lies.
That's the deep dive.
Thanks for joining us for this deep dive.
My pleasure.